Welcome to my video on ASA320, which is about materiality in planning and performing an audit. Now you might think, why is materiality important? Well, it comes back to the purpose of our audit. The purpose of our audit is to make sure that our financial statements are free from material misstatements. And that key word there is the idea of materiality. What is this measure of the misstatements that we're interested in finding? I'm not interested in finding if you've stolen a roll of toilet paper, some cutlery from your kitchen, or some post-it notes. I'm interested in only the really important misstatements. When we look at our contents here, if we zoom in, there's a few specific areas within this standard. And you might notice compared to ASA315, this is actually quite a small standard. We're going to look at how we calculate materiality when we do the audit, and we're going to look at how we need to revise that as we progress. And always, you'll notice that there's always a documentation section. How do we make sure that we're documenting our judgments on materiality appropriately? And that is critical. We are still making professional judgments because there are no hard and fast rules on determining materiality. As usual, our standard here does comply with ASA320. So if you're an international student, then you're getting all the same information in ASA320 as you are in ISA320. Let's dive into our standard here. So I'm going to start with the scope. Remember, the scope is always, what is this standard about? It's about the auditor's responsibility to apply the concept of materiality in planning and performing the audit report. So remember, everything in our 300s series is about planning the audit. And then everything in our 500s series is about gathering that audit evidence. So what do we do with materiality at the planning stage and then at the end? Now remember, once we've identified any misstatements, ASA450 says, well, what do we do when we evaluate the effect? And there'll be another video on ASA450 to look at how we actually evaluate misstatements. In the context of the audit, financial reporting frameworks often discuss the concept of materiality. And in Australia, that's AASB 110, and there's rules about 5 and 10%. Anything less than 5% not material of a base, anything greater than 10% is material, anything in between these is a professional judgment. So although financial reporting frameworks discuss materiality in different terms, we have the same basic overarching driving principle. They're misstatements, including omissions, that are considered to be material if they individually or in aggregate could be reasonably expected to influence the economic decisions of users. Now let's break that down a little bit because that's a bit, I guess, wordy. So they're misstatements including omissions. So omissions are information that is missing or information that is incorrect. All right, so I'm going to add a little note here. So that's incorrect or missing information. Now, it's considered material if they individually or in aggregate, so that could be one misstatement or multiple together, could be reasonably expected to influence what they call the economic decisions. Now, remember that we're looking here at our shareholders. So their economic decisions are pretty simple, right? They've got cash that they choose to invest in our client. So when it comes to the economic decisions, they have to make a decision to buy, to sell, or to hold their existing investments. So what information is going to be important enough to change a shareholder's mind about buying, selling, or holding? And this is where it gets really tricky because this is a relative measure. All right, and there are, when we look at the word users, many different types of users. Right? Think about shareholders. We have mum and dad shareholders. We have sophisticated investors. We have fund managers. We have day traders. Fund managers could be of various risk profiles and persuasions. So there are many people who could be shareholders or users, which means that this threshold amount could be very different for different people. That certainly complicates things for auditors. Judgments about materiality are made in light of circumstances affected by the size or nature of the misstatement. So this bit is quite important here, size or nature. And what that tells us is that there are two components to materiality. There is clearly a quantitative aspect to materiality, but there is also a qualitative aspect, a non-financial aspect. So that's what I mean when I say size or nature of the item. So we have to make these professional judgments, and it says consider the common financial needs of users as a group. So not any one specific user, but the whole set of users. So if we scroll down a little bit here, we're going to get to some important definitions. And the first one is that the determination of materiality is a matter for professional judgment. That means that there's no single right answer. It also says that to be able to do this, we need to understand our client. So the auditor has to assume that users have a reasonable knowledge of the business, understand the financial report, recognize that there's risk, and make reasonable economic decisions. So these are the things that we expect our users to be able to know and understand, and we make our professional judgment with that in mind. So if I scroll down here, we've got an important section in number 5. Materiality is applied during the planning and the performing of the audit and evaluating the effect of misstatements. So I set my materiality in the planning stage. That will help me identify perhaps changes in accounts that are bigger than a certain threshold. And then when I'm gathering evidence and evaluating it and saying, is this material or not, I'm looking at those two components. I'm looking at that quantitative component and that qualitative component to determine whether they are material. Paragraph 6 says, when I plan the audit, my judgments about misstatements will be considered material, and I have to think about 3 particular factors. The nature, timing, and extent of risk assessment procedures at the client. My job is to assess the potential risks and then decide how I'm going to go and collect the audit evidence. Now, the next paragraph is an important line here. Materiality determined when planning the audit does not necessarily establish an amount below which uncorrected misstatements will always be considered immaterial. All right? That means that I might find something that is qualitatively material, or my materiality level may change during the audit. So just because I set it at the planning stage, something may adjust as we go on and gather more information. So I might gather information about an extra risk that is actually going to change my materiality. Into our definitions here, the performance materiality is the amount set by the auditor at less than materiality for the financial report as a whole. So really we have 2 levels of materiality. We have planning materiality, which is what we look at for the entire set of financial statements, and then we also have performance materiality. Now this is sometimes called tolerable levels of misstatement for particular accounts. So you have materiality for your overall set of financial statements, and then you might set a performance materiality for a specific proportion or component of the accounts. So far that's just background information. Now we're going to get into the requirements. All right. So how do we actually calculate the materiality when I'm doing the audit? Well, when I'm doing the overall strategy, that initial planning phase, I need to calculate materiality for the financial report as a whole. So what does that mean? I'm thinking about, an overall impact on the balance sheet or the income statement, an amount that's going to be important that is going to influence the economic decisions of users. All right, so I do that and I come up with that overall strategic level, but I shall also determine materiality to be applied to particular classes of transactions. And remember, this can vary, and it varies according to the level of risk. So if you have an account that you believe is significant in terms of inherent risk, you're going to set your materiality to a different level than an account that is not as high risk. You can check out my other video. I'll put a little link to it in the description and a little card to pop up that actually shows you in a graphical sense how materiality and risk interact. The next section in terms of paragraph 12 is really important. Revision as the audit progresses. The auditor shall revise materiality for the financial report as a whole or for particular levels in particular areas if we become aware of information that would have caused the auditor to have a different amount initially. So essentially what this is saying is if we discover new risks or new evidence that might indicate there's a greater proportion of misstatement or a greater chance of misstatement, I need to revise my materiality down. Now, if I am changing my materiality, it almost always goes down, it doesn't go up. I might also need to consider what audit procedures I'm doing. Do I need to collect more evidence or change the evidence that I'm collecting? Is there more risk? Do I need to perhaps collect other sources? Not just an internal source, I might need to go to an external source as well. Our last part, of course, is documentation. Documentation always pops up towards the end of our standards. So I should document the following information. Materiality for the financial report as a whole, materiality for particular sections, all right, so that's often something that you'll decide as you go through the audit, the performance materiality, and any revisions. So this is really important to make sure that if we do change materiality or we make our materiality our initial set of materiality, it's really important to make sure that we justify our choices. All right, that means we need to justify selecting an appropriate base for materiality. And I've got a video on selecting the right sort of base when it comes to materiality, and then selecting an appropriate percentage. Most firms will have a standard set of measures and guides for high risk, low risk, and medium risk clients in terms of calculating that percent. As usual, our explanatory material I will leave you to have a look at, but you'll notice that the first item is materiality and risk. Make sure you check out my video on materiality and risk. If you have any questions about ASA320 in terms of materiality, then please drop me a comment. I'd really love it if you subscribed. If the video was useful, give it a thumbs up, and I will see you in the next video.